Hello, friends. Welcome back to the Kuderna podcast. I'm your host, Bryan Kuderna. Today is November 25th, 2024. If you're watching or listening live, let me be one of the first to wish you a happy Thanksgiving. And I really wanted to kind of time and date stamp this episode as it fits nicely into the end of the year and some of the end of the year planning that many of you may be doing. Today's episode, we're going to focus on tax loss harvesting. Now, this is something that gets a lot of attention, both from investment gurus, the media. You'll probably hear about it from your tax advisor, your CPA, or your financial advisor, tax loss harvesting. But a lot of people don't understand exactly what it is, and you'll hear different viewpoints on it. While it's a very popular theme, a very popular strategy, it's not new. It's been around a long time. You'll hear people say that every year you ought to be implementing it. And then you'll hear other experts say it's something you should never do, that it's for amateurs. It's not something you should bother with. So in today's episode, we're going to talk about what exactly tax loss harvesting is, when it works, when it does not work, and here at the end of 2024, if it's something that you should be considering within your plans. But first, I want to thank everyone that tunes in regularly and listens to some of the great guests we have on the show here. If you like our program, please like, subscribe wherever you are. That's how we keep spreading the good word, and that's how we get some of these high-profile guests here on the show. So I really do appreciate that, and we're going to get right into it today on tax loss harvesting.
All right. Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
Kuderna Podcast.
All right, so welcome back. Again, today we're going to be discussing tax loss harvesting, when it works and when it doesn't, and how to use it here in 2024. So in short, the concept of tax loss harvesting is to offset capital gains with capital losses. All right, so when you invest in any asset, that could be a stock, a bond, a fund, it could be real estate, collectibles, cryptocurrency, any of these assets of value, when you invest in them and you have gains, more often than not, you're going to have to pay taxes. That's the way it works. And now I want to put a quick footnote here as we discuss this strategy and just mention that this is applying to taxable accounts. All right. And yes, it applies to real estate and a lot of other things that we're not really going to get into today. That's beyond the scope of this episode. But we're going to be referring to taxable investment accounts. Those are individual brokerage accounts, joint accounts, transfer on death accounts, things of that nature. What this does not apply to are retirement accounts. So if you're thinking your 401k, your 403b, IRAs, Roth IRAs, things of that nature, there is no such thing as tax loss harvesting. All right, so you need to be very clear on that. And the reason being is that these qualified retirement plans that I just referenced, they all grow tax deferred. So as you buy and sell throughout the year, you don't have to worry about incurring taxes. But when we go to taxable accounts, right, that is something where you do have to pay mind to what are the tax consequences of all of your investment decisions. And that's where tax loss harvesting comes into play. So like I mentioned a moment ago, the purpose of it is to offset capital gains and capital losses. Okay. In short, let's say that I buy shares of Disney. And just grab that company hypothetically, and I bought it for $5,000 several years ago, and today it's worth $10,000. It doubled in value. If I were to go and sell that position today and say, I totally want to liquidate it, I'm done with my Disney holding, moving on to something else, I sell that, well, guess what? I have a $5,000 capital gain. I will now owe taxes on that gain. But on the flip side, let's say within my portfolio, maybe in that same account, I have another holding that's done really poorly the past couple of years. And I say, you know what, I want to cut ties with it. I'm moving that out of my portfolio. I'm selling that at a loss. All right, that is a capital loss. Hypothetically, if I put $10,000 into that other position, it dropped, it cut in half. Now it's only worth $5,000. And I say, I'm done with it. I'm cutting it loose. I'm going to eat a $5,000 loss. Well, guess what? I can offset that $5,000 loss versus that $5,000 gain that I had in Disney, let's say. And now when I do my taxes, I don't have to report a capital gain there, or at least there won't be taxes owed because of those offsetting gains and losses. In short, that is what tax loss harvesting is. Now, as you go through your portfolio and you say, well, I've got a lot of different holdings in here, that's when you can start to play with some of those and say, okay, how can I make my portfolio perform the way I want it to, but also perhaps generate some tax benefits for myself, okay? So some things I just want to do before we get further into this is just refresh everybody's memory on how here in the United States of America, capital gains taxes work. A lot of people get confused by this, and they confuse it with their retirement accounts and income taxes and so on and so forth. All right, so in short, you have two types of capital gains. You have short-term capital gains and long-term capital gains. Short-term capital gains are incurred whenever you buy and then sell that position within 12 months. Okay, so if we do that within 12 months, within a year of purchasing it, we sell it, we are going to be subject to short-term capital gains tax. What is short-term capital gains tax? That simply says it's being added to your income. It's going to get taxed as ordinary income. That's what it is, folks. Now, long-term capital gains tax, how does that work? That's when we hold an investment for over 12 months. All right, so we purchase an asset, we hold it for at least 1 year, and then at some point in the future, we sell it. If there's a gain there, we now owe long-term capital gains tax. That receives a much more favorable tax consequence than short terms, all right, in most scenarios. All right, so just to kind of add a little bit of flavor to that, short-term capital gains, again, that's just simply income tax. As it stands right now in 2024 and also in 2025, we have 7 tax rates that people can be subject to. That ranges from 10% all the way up to 37%. All right, depending on your income, what bracket you fall into. If you buy a security, a stock, some asset, and then it appreciates and we sell it 3 months or 6 months from today, that gain is taxed right on top of your income, and you could owe anywhere from 10% to 37% tax on that gain. That's short term. Long term gets, like I said, preferential treatment. And the reason is the government, they do not want people buying and selling rapidly within their accounts, just looking for quick profits. All right. They prefer to have long-term investment in capital appreciation. That's better for companies. That's better for the economy. And so as such, that is receiving a bit more of an incentive through the favorable tax treatment that long-term holdings get. All right. So in 2024, a single tax filer that's subject to long-term capital gains tax, they could fall into 3 categories. They owe 0% for a long-term capital gain if their adjusted gross income is below $47,025. They will owe a 15% capital gains tax if their income is between that $47,026 and $518,900. All right, so most investors out there that are kind of middle America, we could say, when they hold an investment for more than a year and then sell it and are subject to a long-term capital gains tax, it is at the rate of 15%. Now, if you're making more than that, all right, you're a single filer and you make over $518,900 a year here in 2024, you will be subject to a 20% capital gains tax. Okay, so those are your long-term capital gains tax rates. All right, we can see what those are. They're going to remain the same in 2025, but will be indexed slightly for inflation on each category, just by a little bit. But there's still those 0, 15%, and 20% rates. Okay, so naturally you could see, all right, if I bought an investment today, and then 12 months from today, I'm saying, you know what? I think it's time to sell this. I really want to move it. If I'm a high earner, if I'm in the highest categories there, if I were to sell that at 11 months, all right, I'm going to add that to my income. I'm paying a 37% tax on that gain if I'm in the highest income tax bracket Whereas if I just held it for one more month and went over a year of holding that asset, now I'm subject to 20% tax. So that a little bit of a sidebar on tax loss harvesting. This is something all investors ought to be aware of, is that if you can hold it past 12 months without having some negative consequence to your portfolio or your investment plan, tax-wise, that's always going to be more beneficial than short-term trading. Now, on top of that capital gains tax rate, there is what is called the net investment income tax, or the NIIT. This is commonly referred to as the Medicare tax or Medicare surcharge, which is an additional 3.8%. Okay, if you're a single tax filer and you make over $200,000, you're subject to this NIIT, the net investment income tax. If you're married filing jointly and you guys make over $250,000, then you're getting this extra 3.8% tax. Again, what a lot of people just refer to as the Medicare tax. So what does that mean? That means if I'm a high earner, if I'm in that highest tier and I hold an asset for a long period of time, over 1 year, I sell it hypothetically at a gain, I could be subject to a 20% capital gains tax and then 3.8% surtax on top of that. Now I'm paying 23.8% for that. Now, let's say, again, if I didn't hold it long term, if I only held that asset for 10 months or 11 months, well, guess what? It's added to my income, 37% plus the 3.8 NIIT tax, all right, the net investment income tax. And now I'm paying over 40% tax on that gain there. So that shows you again just how harsh that short-term trade could be and why people want to hold that for at least 12 months, ideally, if they can afford to. Now, everything that I've been discussing here, all this tax conversation, you got to remember, one, this is not retirement accounts. All right, these are taxable accounts that we're investing in. And two, we are speaking to what are called realized capital gains. What that means, what a realized gain is that we actually sold the underlying asset. All right, so we've realized the gain or the loss there, and then that generates a tax consequence. All right, opposite that is what we have are unrealized gains, or what a lot of people just like to call paper losses and gains. That means throughout the year, I'm getting my statements. I see some positions are going up. I see other investments are going down. We're back and forth. All of those are unrealized. None of that is real until we decide to, quote unquote, pull the trigger and say, I want to sell. I want to sell or liquidate that position and lock in that gain or lock in that loss. And at that point, that's when we generate a tax consequence. All right, so that was a little refresher on how capital gains taxes work, because before you go to tax loss harvesting, you got to understand, why do we even want to do that in the first place? So now, with all of that in mind, when do we use tax loss harvesting? When does this whole offsetting game actually work to our benefit? All right, there's essentially three scenarios that I would boil it down to. The first one is we have an appreciated asset and we want to start to, maybe pare back some of our winnings or our gains there. All right, that could be one scenario where you're saying it's grown tremendously and now I want to rebalance my portfolio. So I want to shrink that position a little bit to kind of get back to maybe my original outlook or model. Or you're just saying, I want to keep this thing. I love this stock or this whatever asset it is that I'm holding. But man, I've got so much appreciation in there. At some point down the road, I'm going to get crushed in taxes on this. So what I'd like to do is readjust my basis. I'd like to pay a little bit of that tax now, realize a little bit of this gain now, so that I'm offsetting just how much I might possibly owe in the future. All right, so what happens then is we got this appreciated asset. We sell all of it or we sell a portion of it. We now have a realized gain. Hopefully we held it for at least 12 months, like I mentioned before. And then opposite that, we're going to look through our portfolio and say, okay, is there a loser in there? Is there a depreciated asset that maybe I can sell to offset that? So now I'm able to sell the winner, sell the loser, and I'm not having any tax consequence because of that offset. Okay. On the flip side, let's say you just have a losing position and you say, you know what, I want to remove this from my portfolio. Forget about all the good winners, the good things I've had. There's this one in there that we just don't need it anymore. I've lost faith in it. I don't think it fits. So I want to cut it loose. And when we do that, we're going to realize a capital loss. Now, we may go searching for something that has gains to sell so we don't waste that loss. So we can actually apply that capital loss to a capital gain, kind of like I mentioned in scenario one. But one thing to note is you don't necessarily have to sell a winner to leverage the tax benefit of the loser. So what does that mean? Well, there is a capital loss deduction, an income deduction that all Americans are entitled to. And what that says is that you are allowed to write off up to $3,000 a year of a capital loss against your income. So let's say we bought a stock years ago. It's fallen a bunch in value. And we say, you know what, I lost $5,000 in that particular stock. I'm going to sell it. Well, even if we don't even touch our winners, you still get to take up to $3,000 of that loss. And then you can write that off against your income. So you get a nice deduction there. Another thing that's really cool is if it was a bigger loss, more than $3,000, you can carry that loss forward. And then in future years, you could either deduct that against other capital gains, or you could deduct the remaining amount of that, again, up to $3,000 a year against your ordinary income. All right. So just because you sell a loser doesn't mean like, oh man, I'm wasting any tax benefit here because I don't want to let go of any of my winners yet. All right. All that it means is you can deduct $3,000 up to that each year against your income. So that's kind of nice. It's a little silver lining there of frankly, a bad investment. Now, one thing to be clear of. So if we start to actually implement tax loss harvesting, the way the IRS looks at this is you are allowed to offset long-term capital gains and long-term capital losses. All right. Those are going to offset one another first. Then you can offset your short-term capital gains with short-term capital losses. Okay. Those will get applied to each other. If we've exhausted those, let's say that we just got crushed in an investment this year, big short-term capital loss that we've suffered. All right. And we only had something that we invested in this year. We got a small short-term gain. All right. Then we can offset that short-term gain. Any of the excess, then we could apply to any long-term capital gain that we may have incurred. Okay. So they offset like to like. And then if there's any excess remaining, that's when we can mix and match short and long and short. All right. So that's something to keep in mind. Now, you might be saying to yourself, well, what if I just want to do this without adjusting my portfolio? And I just want to try and find, is there a tax benefit here that maybe I can leverage in a good year or a bad year? You just need to be very careful of what's called a wash sale rule. Okay. And you can look this up on the IRS's website. Again, that's called a wash sale. What this says is that if you sell an asset for a loss, okay, we're doing tax loss harvesting, investment A had a nice gain. We sell investment B at a loss. We offset it. All right. So we were able to lock in a capital gain. We're not owing any taxes because of the offset. And then as soon as we do that, we go back into the loser. All right. So now we have not changed the losing position at all. All right. And we were able to lock in that gain without any tax owed. All right. The IRS is obviously smart to that. That's called a wash sale. What that states is that you cannot sell the loser, claim the loss to offset the gain, and then within 30 days, go back into what's a quote unquote substantially identical investment. If you were to do that, that would disallow the loss. Okay. So you would lose that loss that you're trying to offset with. So you may say to yourself, well, is there any other sort of kind of workaround to that? In a sense, maybe there is. You can either A, say, you know what, I'm going to sell the loser, and then I'll wait 31 days and I'll go back into that same investment and move forward from there. Or B, you could go into something that's similar, but not substantially identical. So perhaps you sell a stock that's in a certain sector And then you go into maybe a like sector, but it's something different. It's a different stock, or it's a different fund that has some differentiating factors. All right. So maybe it's in the same stadium, but not in the same section. All right. That's the way that I look at it. Now, you got to be careful with that. I'm not giving that as advice. It's just a strategy, a technique that can be deployed, but you definitely want to speak with your financial advisor and your tax advisors about that. All right, so just to recap on tax loss harvesting, we're locking in gains and then we're looking for losers to offset it. Or we have losers we want to get rid of. And so then we say, all right, let's sell some winners and just take advantage of that and then adjust our basis in that winner. So we've moved that up, hedging, future taxes that may eventually be owed. All right, so that's kind of those two scenarios. Something I just want to, not to muddy the waters too much, but elaborate on the winning side regarding that wash sale rule. Wash sale rules apply to losers, all right, that we're writing off a loss. They do not apply to winners. What does that mean? Let's say I sell a loser. I know I'm done with that. I'm going to move into another investment, or I'm going to spend those proceeds. I'm not concerned at all about the wash sale rule. I'm selling that stock. That's that. On the opposing side, I've got a winner, and I'm going to sell a portion of that to bump up my basis, lock in some of those gains, not owe the tax because of an equal offset. And then the next day, I want to go right back into that same stock because I'm still bullish on it. I think it's doing great and I really like it. I think it has a bright future. You can sell it, lock in the gain, not owe the tax, assuming that there's an offsetting loss, and then go right back into that winner now with an adjusted basis that you just stepped up. Okay, so keep that in mind. That's kind of cool on the winning side. The wash sale rule, that applies to losses. You got to recognize that. All right, then the third scenario, and this is the one that I like, which I'll speak more to in a second, is when tax loss harvesting happens organically. What do I mean by that? That means that we are managing our portfolio, we are rebalancing, and the gains and losses just happen as a symptom of our investment management. And then naturally, when we have some losses and we have some winners, they can offset each other when we do our taxes, so that we're tax loss harvesting, but I would say without intent. It's just happening as a byproduct of our investment strategy. Okay, that's kind of the final scenario of where it can work. Just something that I also want to kind of elaborate on, because I get a lot of questions on this, is, well, what if I have a stock or a fund, let's say the S&P 500, and it's not like I just bought it 5 years ago with a lump sum and then just watched it for 5 years go up and down, but rather I continually invest in it. Maybe every month or every quarter, I have what we call a PIP, or a periodic investment plan, where I'm dollar cost averaging into that investment continually. It wasn't just a one-time deal. Or maybe I have what they call a DRIP, a dividend reinvestment plan, where I'm, again, continually buying into that same asset. But then this year, all of a sudden, I say, you know what? I want to lock in some of those gains. I want to sell it. I do have some losers I'm done with. I can now do some tax loss harvesting, have some nice offsets. But am I going to be subject to short-term gains? Because while, yes, I did start investing in that 5 years ago, I also made investments a little bit every month of this year, of 2024. So now when I sell it, am I getting stuck with short-term capital gains? The answer is you can elect the accounting method on that. And what most people choose is what's called FIFO, first in, first out. What that means is we can assume that the first investments in there are the first ones out. So those deposits, those investments we made 5 years ago, are technically the ones that are being sold today. And so obviously we would get taxed as long-term capital gains, much more favorable. And then we can do our tax loss harvesting from there. So that's just something I get questions on quite a bit. So I just wanted to clarify that. So that is tax loss harvesting in a nutshell. And now, like I mentioned at the outset, we're at the end of November 2024, approaching Thanksgiving. We are having a great year in the stock market. At the time of this recording, November 25th, 2024, the S&P 500 is up just over 26% year to date. All right, so we're having a really good year. And guess what? 2023 was also a really good year in the stock market. So two things are happening right now with a lot of investors out there. They're saying, A, I want to rebalance my portfolio. All right. I do that naturally. Maybe I like a 60-40 portfolio or 70-30, whatever the strategy is. But now we've gotten way overweight equities. Okay. Maybe we're way overweight large cap stocks, tech stocks, the ones that have really rallied. And so it's kind of made our portfolio a little bit off kilter. So now as I go to rebalance that, I'm going to have a lot of winners. I'm going to have a lot of gains in that this year. Okay. It could be a portfolio in years like this where there may not be any losers and you just have to eat those gains. And unless assuming you have some carry forward losses from prior years, you'll just have to eat the gains. That's one thing. Or you might have people saying, you know what? It's not that I want to rebalance. I just, as a whole, maybe I want to shift a little more conservative, be it for whatever is going on in your life, or because you're saying we just had 2 killer years in the stock market. And I don't know if we're going to do it again for a third year. So I would just be more comfortable taking some chips off the table, getting a little more conservative. Again, this is where tax loss harvesting can come into play. That's what people are going through right now as we approach the last month of 2024. This is when we want to look at the portfolio and see if there's opportunities for offsets there. Now, this is my own opinion. What I do personally and the way that I advise the majority of my clients is that, like I mentioned before, that option 3 of when tax loss harvesting happens organically, that's when I like to see it. So in short, what I always say is I do not want the tax tail to wag the investment dog. All right. When I create a portfolio, be it for my own money or for all of my clients out there, my goal is to get an optimal investment outcome, not an optimal tax outcome. Now, if we can be the best investor possible and obviously be tax conscious and leverage some tax loss harvesting along the way, then of course we want to be mindful of the tax consequence. But we don't want to just chase tax benefits, possibly at sacrificing the returns, the whole point of investing, because we're just so focused on the tax outcome. So again, the way I always tell people, don't let the tax tail wag the investment dog. Okay. So that's just a quick summary on tax loss harvesting. I hope I was able to cover it, give you a general idea of what it is, when it works, when it does not work, and how to think about it here in 2024 as we're coming off of 2 really good years in the markets. Probably a lot of winners, a lot of gains in most of the portfolios out there. Keep in mind, you can sell some of the losers, but be careful of the wash sale rule. If you don't want to abandon those losers, you want to give it a chance to rebound. Well, then maybe you don't want to do it, or you might have to say, I'm going to wait 30 plus days before I can go back into that holding. But on the flip side, if you have some winners and you just want to step up your basis, you're getting rid of those losers anyways. Now's a chance where you can do tax loss harvesting and you can go right back into that winner if you want to. So those are some things to consider. If you have questions, if you have more that you want to learn about this, if you have guests or something else you want to talk about, again, please communicate with me through social media, Bryan Kuderna or B Kuderna. You can find me anywhere. You can also email the Kuderna podcast at gmail.com if you have a particular guest or topic that you'd like to hear more about. So this episode, please note that this was for educational purposes only. It should not be construed as specific financial advice. As I always say, a little disclaimer, please consult with your own financial advisors and tax advisors to discuss your situation and if tax loss harvesting might be applicable for you. I'm your host, Bryan Kuderna. Thanks for tuning in to another episode of the Kuderna podcast, and we will see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.